Three, two, one, let's jam. Hello and welcome, everyone. I'm Corey Hofstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
My guests today are Roxton McNeal, Managing Director and Head PM of QIS Investments, and Siddharth Sethi, Portfolio Manager and Head of QIS Structuring. Together, they're spearheading the development of QIS-driven solutions at Simplify Asset Management. In this conversation, we explore what it takes to build and manage a multi-strategy QIS portfolio, from infrastructure requirements to portfolio construction and risk management. We discuss the structural versus academic premia distinction and why it matters, how Simplify evaluates and customizes QIS offerings from banks, the need and challenges of dynamic allocation across dozens of strategies, how QIS strategies integrate with traditional beta portfolios, and the operational and counterparty considerations of trading these strategies. For those interested in the practical realities of QIS investing, this episode provides a deep dive into both the opportunities and challenges of running a systematic multi-strategy portfolio. I hope you enjoy my conversation with Roxton McNeal and Siddharth Sethi. Sid, welcome to the show, and Roxton, welcome back for your second appearance. Excited to have you both here. Sid, I want to start with you since you are new to the show. Let's start with your background. And then after that, Roxton, maybe you can jump in and catch us up with where life's taken you since you were last on the show. Amazed to say this, but 4 years ago.
Hi, Corey. Thank you so much for having us. Very nice to be here. I have an engineering background, very quanty. I started off trading rates derivatives straight from college for a fund, mostly UK, Europe-based, short sterling gilts, Bunds wobble chats. Did that for a few years, and I thought of taking some formal education, and I went into Columbia here in New York. It was great to see an introduction email from Emmanuel Derman, who was then heading up the department, so it was pretty great. Shortly into the program, I started an internship at one of the New York local funds, a couple of $1 billion, and the focus was more commodities and energy, power, utilities, equity stuff, and systematic strategies focused. Worked with some great minds from some of those multi-strat funds, neuroscience PhDs and whatnot. It's a great place to learn. Shortly after, I got called into Bank of America, Merrill Lynch, and now BofA. And I started working within the equity derivative structuring team, which basically begins my Wall Street career. Very, very smart people. I was focused more on QIS there. Of course, everybody has to do everything, but QIS was the main focus. And slowly did more and more of non-linear QIS, which for people who want to differentiate, I mean, linear would be more where you are taking linear risk, and non-linear would be more where you're doing more vol and options and variance swaps and whatnot. That was my stint at BofA. I spent a lot of time doing that before, again, this very smart lady from Barclays said, hey, would you want to come in and head up our non-linear QIS structuring team in Americas? I did that. I joined Barclays for a few years, worked again with some very amazing people. During that time, I was working with, of course, a lot of clients, both institutional, hedge funds, and some retail clients. Within this whole ecosystem, one of the clients that we had was Soros Board, which had basically spun off with a couple of $1 billion and started doing things on their own. And they basically asked me to come in and run a QIS portfolio for them. And so I started doing that. This is basically my first stint back to buy side after Wall Street. Between this time, there was a transition period where they were changing their entity to make sure that, they have good tax laws and whatnot. And during that time, Roxton reached out. He said, hey, I'm building this at Simplify. We got to do this. Let's do it. Let's get on board. And I could not say no. So here I am at Simplify.
Thank you, Corey. And it's an honor to be doing this a second time with you. Much appreciated. 4 years ago, when we first did the original podcast, I was at UPS managing QIS strategies for liability risk management and overseeing a substantial pension portfolio with a focus on derivatives and systematic approaches. Since then, life has brought me to Simplify Asset Management, where I've been leading the quantitative investment strategy initiative here, shaping both the ETF and SMA offerings. It's been quite an exciting shift, moving from a large established framework into an entrepreneurial environment.
So let's start the conversation a little bit of a table setter. What ultimately is the service that you're trying to deliver at Simplify?
Our service really draws on the expertise from institutional due diligence and investors, structurers, traders, and strategists to managing QIS and derivatives. We offer tools like the QIS ETF and SMAs, with QIS strategies, both defensive hedges like convexity and carry plays like volatility premium to mitigate tail risk and generate returns that are independent from traditional markets or beta sources. We understand structural premium, dynamically constructed portfolios, and manage risk with real-time tools and stress tests. In a market with these shifting rates and correlations, we really believe that this program enhances stability and returns to a given portfolio. It's delivered efficiently in a fiduciary framework with daily liquidity, no K1s, low cost and transparency for the ETF, yet seamless for SMAs, blending decades of know-how and a real streamlined solution.
Both of you, prior to this move, were working at much larger established firms and have now migrated to something much more of an entrepreneurial endeavor at Simplify. Curious as to what the practical differences are. What are sort of the distinct opportunities that affords you, and what are the challenges that you face moving out of a more established arena?
When we last spoke, I was working at a large institution with a multi-billion-dollar framework. I was very methodical, heavily governed, focused on long-term stability under very strict fiduciary standards. Now at Simplify, it's much leaner, more agile environment. Decisions are made very quickly, processes are streamlined, and the entrepreneurial mindset really emphasizes adaptability within this organization. The opportunity sets are significant. We can innovate rapidly, really enhancing our QIS ETF or tailoring SMAs without bureaucratic hurdles. We're expanding access to sophisticated, uncorrelated return strategies for advisors and individuals, not just institutions. Challenges include the need for precision. Simplify's model demands we optimize every move efficiently. Building our reputation in a competitive space is another task. Where my prior role carried inherent credibility, here we're proving our worth. It's a transition from maintaining a legacy to really shaping a forward-looking platform, blending both agility and disciplined execution.
There's nothing more that I could say more than Roxton just said. For me, there's pros and cons. Pros being, if you're at a very big place, you have all the tools and all the benefits and all the economies of scale available to you to help you out every single day, every single moment. But at the same time, they are so built in and so fixed and so restrictive that sometimes you can't go around them and do stuff that you have to do and you have to deliver. We have a new start, which basically means that we can create stuff based on how we like, how we see the future to be, which makes us very nimble and able to adapt to different things which are happening. I think even if you look at QIS itself, what QIS was 10 years ago is not the same anymore. It's a whole new flavor of it, where the operational ease that the banks are offering is more in tune with the premia itself. As things change, I think the platform also evolves. And the good thing is that we are trying to build a very nice, very agile platform where we can actually, in fact, add things on top as we grow.
I want to get into the actual portfolio work shortly, but before we do that, I am curious about the infrastructure requirements of all this. Talking about going from large structured organizations down to a much more entrepreneurial venture. As you're building out this new business line, how do you think about the minimum requirements for team and technology stack and operations?
Infrastructure, of course, including both the intellectual capital and the technology stack, is key for something as operationally intensive as QIS, with multiple lines or line items in general. At a very basic level, and if you just take a step back, One would need, of course, portfolio managers to understand, allocate, and manage the risk. You would need sales and strategists to help with idea generation, idea filtering, reaching out to clients and make sure how it fits in their portfolio, because ultimately it is a service. You would need quants to help build and maintain those models, technologists to build and create the tech stacks, and of course the database management systems, the risk analysts, the risk officers, again, second line of defense after the PMs to look at risk, and also, and more important task of the regulatory risk, because we are part of an ETF community, we have to follow certain guidelines. So they are a big help in that, and they know how to do it on an everyday basis. Operations, booking stuff, in general, like every part of the trade lifecycle, it starts and ends with the operations team. And legal, all the ISDAs with the banks, the credit support annexes, the investment management agreements, everything starts and ends with legal. There's a wide breadth of things that you would need to set up a business similar to this, and it can take a minute. I'm sure Rox would agree, but the transition for us was fairly easy. Simplify already had that platform built up. It was nimble enough for us to sort of onboard and quickly start ramping up. I'll also take this opportunity to shout out to Simplify, because we've just become part of that bigger family very, very quickly, and we start to ramp up things right now.
QIS is one of these terms that I feel like has been increasingly getting attention and spotlight over the last couple of years, but in and of itself is a pretty generic term. Roxton, in our pre-call, you mentioned the idea that QIS differentiates itself as often having a focus on what you called a structural rather than an academic premium. I was hoping you could expand on what you meant by that.
I don't think the QIS itself is differentiated that way. That's a taxonomy that we place on it because of the way that we look at the structures. QIS, I think, at a very high level, is a systematic rule-based strategies that banks create to seize on opportunities and manage their risk and offer the investment to managers. At Simplify, we take that universe and we shape our own taxonomy framework around that. And there's many ways to classify taxonomy. You can look at asset class, style, horizon. We take a more quantitative approach and multidimensional approach when we look at the taxonomy. But looking at risk premia specifically, we do believe there's a distinction between structural and academic types. Academic premium, like value or size, are all rooted in economic theories. Value, for instance, can be constructed variously from price to book, differing across institutions, yet they're all fairly static and prone to erosion. Structural premium, on the other hand, arise from persistent market inefficiencies, liquidity constraints, hedging flows, vol premiums, where implied exceeds realized. These require a dynamic allocation as their strength shifts between the market conditions. Crowding can dilute them or stress can amplify them. We adjust those exposures favoring convexity or volatility and stability, and to really capture the fluid market-driven edge to really ensure that uncorrelated absolute return.
Combined, the big banks offer hundreds, if not thousands, of QIS indices that you can evaluate. You can talk to your bank rep, and they're more than happy to send you a booklet of all the strategies. And the newest, brightest, shiniest ones will be right at the front. The cliche, of course, being that you've never seen a bad back test. Curious how you get comfortable in evaluating these offerings, especially recognizing that the banks are not fiduciaries.
That's correct. Banks obviously present a vast array of these QIS indices. And as you said, it's a favorite saying of ours, it simplifies, you never see a bad back test. The challenge really is in separating the repeatable premium from overfitting. We take a very disciplined process. First, we start with an economic rationale. Does it target a persistent structural inefficiency? It's got to make sense. We then test the robustness by really validating at a sample across diverse periods and stress scenarios that the market's given us, like '08, COVID-19, and really probe for the fragility by tweaking the parameters. At Simplify, when we are looking at a particular strategy from a banker or interested in it, we'll actually take the rule book that they have created the strategy around and we'll model it internally. So we will actually model the strategy to make sure that we tie out to the performance that banks gave us, which really allows us to stress test with the parameters, do in and out of sampling. Obviously, they're only going to show you one path that this particular strategy took. We run Monte Carlo simulation analysis, bootstrapping methods. There's a whole framework that we go through on quantitative analysis to really get an expectation of what its ex ante risk profile looks like. Big believers in garbage in, garbage out. If you don't really understand what you're investing in, the next step, which is to aggregate and create the portfolio around it, is very difficult because you don't even know what you have. Cost and scalability is key as well. We replicate the strategy so we can uncover those real expenses. We know what the primitives are that build up these strategies, so we're able to negotiate with the banks a little bit on the cost of their offerings. And throwaways really lack economic grounding. They only really perform in narrow data sets and really falter under cost pressure. Those we just throw away. So I'd say at a high level, it's really a blend of quantitative rigor and practical judgment to really ensure that only durable strategies make it into the portfolio and make the cut.
We're not starting from scratch. We've seen and used these strategies for such a long time that we've never asked for a big bad file of QIS strategies with 20,000 line items in there. Given our approach, we know the type of risk that we are looking for, the type of risk that we want to add in a book and where it fits. We would go in and ask for that specific risk premium, which of course narrows it down already from the thousands that you see across the street to maybe 100, which is viable. Thankfully, that helps us a lot as well. In terms of the process that we use, and I think Roxton mentioned to it, the quantitative aspect and there's a practical judgment. If you were to summarize roughly at a higher level, what does that thought process look like? I think there's 4 things. There's a premia, there's a risk, there's an outlook, then the last one is crowding. The premia is generally understanding what the premia is, how it functions, when it works, when it doesn't work, where does it fit? That's one, because ultimately it has to be part of the portfolio. We are not starting from scratch. It's sort of the marginal benefit that can have on the portfolio, that's premia. The second one is risk. Again, what is the risk that we are taking? Let's say if we already have something which is selling the gap, then adding more short gap is not going to help us. We might want to go in the commodity land, or we might want to sell some calls, or we might want to sell some rates, something which is sort of differentiated and adds to the returns while not adding to the same risk at the very least. So that's risk. Third one is outlook. For us, outlook, again, trying to understand how this premium would behave in the coming months. I mean, if vols are pretty low and constantly realizing higher, I mean, you might want to switch away from implied to realized. While if the vols are higher, or even if the vols are lower, but the implied to realized spreads are rich, it's a good trade to be in. So thoughtfulness about the outlook over the next 2 to 3 months at least helps us get an idea of what we expect to make from this trade and how can it look in the portfolio starting from trade date. The last one is crowding. And again, Roxton mentioned it. I think crowding has become very important in the QIS framework overall. We saw it with intraday trend strategies. We've seen it with commodity strategies as well. There's a lot of stuff where the inflow that we see from market participants sort of overwhelms the underlying premia to the extent that you might want to take contrarian positions to extract some. We are very thoughtful around that and the risks it poses. We do want to have some exposure to certain strategies. Again, if something has a very good run and we see all eyes on a specific product or a premia, and we see the volumes rising, we are careful and we do our due diligence quantitatively also while talking to banks and other counterparties to say worth the risk or not. So there's all of that that we have in there. It's a risk premium. I mean, we want to find its place in the portfolio. The costs are important. Both the embedded costs and the in-out costs are something that we would take into account while adding it to the book, which keeps us nimble, keeps us agile.
Can you walk us through your process of evaluating new QIS premia that the banks introduce? For example, in the last couple of years, there's been a big push into zero DTE strategies from the banks. And what immediately comes to mind to me is that last risk that you brought up, which is that crowding or congestion effect that might happen if suddenly they're adopted, but is certainly not going to show up in the historical backtest of that strategy.
The framework that we have, which I mentioned, the premia, risk, outlook, and crowding, is still applicable in this scenario. So even if it's a new strategy, it can still go through the same framework. Zero DTE, what's the premia? There's 2 types of premia. One is out-of-the-money options. So typically, those out-of-the-money options represent gap risk. That gap risk has not materialized a lot. I mean, it's materialized much lower than what it's priced for over the past few years. It can be a good bet to sell those options to make money on an everyday basis. And of course, you lose certain amount when a shock happens. So it's well defined. You know you're taking the gap risk. It's not going away. One day moves beyond 5%. It's tough to happen. It's a premium which is well defined. Now the question becomes, is the price fair? And I think the fair part comes more from the liquidity and the number of market participants that the underlying product has. And it has grown over the years. So that basically helps answer the question of the fair price for that risk. There's a premia, there's a risk, and there's a fair price. So that's on the out of the money option side. And then there's also near the money side. So somebody who would want to buy cheap gamma. It's like zero vega gamma exposure. This is the best place that you can get it. If you're a gamma scalper, or if you're trying to monetize on a move which you think could exacerbate anything, we've seen these types of implementations in intraday trend as well over the recent years. So that part also gives you an exposure which it's difficult to get elsewhere. So again, this premia is there, it's present. There's a value for it, which again is determined by the market and the participants. And as liquidity grows, the price becomes fair. So the premium part is solved. Both of these premium do exist and are available in the market. We've seen it in S&P, NASDAQ also has it, Russell, SXI, almost every underlying, at least index underlying, is starting to have it. In terms of risk, clearly defined risks. If the market goes down 5%, you're paid, let's say, 25 bips for your put option, again, you're selling like 4% out of the money, you're going to get that 75 bips loss. It's well defined. You know what the risk is going up front. The risk is solved. Similarly, for the optionality that you're buying near the money, that delta and the gamma exposure that you want to get into, you know what the risk is because that's the premium that you're paying upfront. So the risk part is also very, very well defined for zero-DTE options. Again, outlook, it's liquidity. I was reading a stat from, I think, from CVOE, where they were basically saying over the past few years, a recent Feb report where the total liquidity in the option market, especially in S&P, 55% of that is zero DTE or 1 day, which is massive. So it just tells you that there are a lot of flows there and people are continuously transacting in this market. The last one is crowding. For us, we've tried to figure out what those flows look like. The 55% of the market, is it unidirectional? Are the flows just selling or is they just buying? From what we've gathered at the moment, I mean, they are pretty balanced and things could change, of course. And we are trying to be on top of it. And we have great partners across the Wall Street as well as market makers who are helping keep us on top of any new developments in the region. So that's how we evaluate it and see where it fits in our portfolio.
Realizing that QIS really thrives on precision, but markets shift, that really becomes the breaking point when those assumptions actually hit the real world. We also at the very high level believe we're very careful about diversification. We think that's key in managing a portfolio of these strategies by really crafting orthogonal risk vectors within the portfolio to create that maximum diversification. We also tailor trades with banks for unique angles to really dodge the crowd. And we also love to build our own strategies for even tighter control for some of the strategies that we think we can bring in-house. Real-time dashboards and stress tests, as I aforementioned, keep us alert. Once we spot a wobble, we can adjust really fast. And I think our ace in the hole is the dynamic allocation. We can ramp up convexity hedges in shaky markets and really lean on carry when it's calm. Crowding is subtle, and we do monitor it. We're very vigilant on crowding. Rising participation, like carry trade getting mobbed, really will set off alarms. Returns thinning or moving in lockstep is another sign. Execution costs climbing probably means the field's a little packed. With our banking partners, we get a sense on capacity and see if that inefficiencies may be drying up or that edge is toast. So it's really a systematic discipline that we apply that gives us the streetwise edge, really ensuring that we can stay robust and deliver what our mandate is.
Since you brought it up, Roxton, why don't we dive into this idea of portfolio construction? Because when you survey the landscape of QIS strategies, they come in all sorts of shapes and sizes and varieties and asset classes and strategy types. And so I'm curious how you think about what the core portfolio construction problem is. Ultimately, what are you trying to solve? How are you then taking that problem and thinking about selection and sizing?
We could probably have a whole podcast on this. But portfolio construction within QIS is really about balancing diversity and coherence. It starts with selection. in really identifying what those distinct structural premium are, which we just went over. We want convexity for asymmetry, trend for momentum, carry for stability, really ensuring that we're getting that orthogonal spread to risk. We use and rely on a multi-dimensional framework. So about 80% of our work is really getting a handle on what we think of the ex-ante expectations of these strategies, using our experience, our quantitative tools, and really boiling it down to a universe of strategies that may fit into the portfolio. The next step is how do we aggregate those strategies? And I think this is something that we do novel. Most people will rely on correlations or covariance matrices to come up with diversification methodology. We use a multidimensional approach. We use a number of quantitative metrics and parameter models against the strategies to create distance measures that get normalized. So correlation in the normal course of things is your distance measure. We use multiple factors to create the distance measure that creates that orthogonality risk vectors for us. Once we have those, then we'll test it. Then we'll test it across regimes where the correlation did go, was flat or went to 1 or -1 during stress periods. How did the portfolio fare? Did we get a better outcome for that diversification? The first principal goal is to be uncorrelated during normal times, but more importantly, during those stress periods, we got to remain at least as diversified, if not better. And that's the second step. That's the aggregation step. Once we have those risk vectors, then it's about the portfolio construction. We looked at it a number of different ways to do that, maybe to hopefully gain an edge, like looking at Kelly's criterion or looking at more drawdown risk to really mitigate bad outcomes or stress periods. But at the end of the day, we went back to the standard of risk adjusted. So it's a vol adjusted. Once we get those risk factors, they're vol adjusted to roll up to the portfolio. The sizing is dynamic. We also aim to balance risk contribution across those clusters by adjusting them with real-time signals from dashboards that we have that actually track volatility and flows. At a high level, the goal is really a resilient, uncorrelated portfolio that adapts to conditions while maintaining consistent performance. And it's really done through a really disciplined selection and tactical sizing.
This touches on the point that we mentioned before. We are rarely looking for a book of QI strategies. We are looking for a specific premia or a specific type of risk that we would want to add in our books. And we already know where it fits in one of our, as Roxton mentions, in orthogonal strategies, which basically form part of the portfolio. So at that level, the way that they are sized and the way that they're constructed is usually very coherent already. So for example, if I'm selling vol, I know that most of the strategies that they're selling at the money, out of the money, where they are, I mean, there's going to be some sort of Vega sizing there. If it's a gap risk, it's going to be notional sizing. If it's a long short, I mean, it's going to be like total gross notional or total net notional. That sort of thing is already there. So that helps us. Those parameters are already defined, which we can actually use easily when we are selecting subset of strategies and putting them on equal footing. As Roxton mentioned, again, there's two decisions to make. One is where to put that strategy within the bigger level of orthogonal strategies, and then essentially how to weight those top level strategies as a part of the portfolio. For strategies which are part of those orthogonal vectors, it's a risk-based sizing where we do understand the risks more closely, whether it's Vega, okay, we know what's at stake at the top level because we do believe that they are truly orthogonal. One by wall weighting should work indeed, because that's how it's designed to be. If they are truly orthogonal, so then something simple should be enough while keeping things simple. At the end of the day, all we're looking at, and simplifying it, no pun intended, is that you have a carry estimate and you have a risk estimate, and we are using that to build the portfolio. And then we have our ways to get to that final number and use it in the best possible way.
When the portfolio is fully baked, how would you compare and contrast it to traditional betas? Is it something that is supposed to replace traditional betas? For example, is this something someone could theoretically, or you would have the conviction to say, I don't want to take traditional beta risk. I'm just going to put 100% of my money in something like this because of all the orthogonal bets embedded within it that you have control over? Or is this something that's meant to be a piece of the bigger pie and offer diversification benefits to traditional equity and bond holdings?
I look at it as the latter. I think that they should view it as a complementary layer, not as a standalone for traditional exposures like equities, credit, or duration. Traditional assets are driven by market beta and macro swings, and we're really chasing uncorrelated return structure, uncorrelated premium. So you can look at it as an ETF, you'll probably have to use it as a piece of the portfolio. But in an SMA, you can actually bring it in as an unfunded alpha or a overlay defensive source of carry within the portfolio. The other thing that I'd say is in some cases, I think it could be within a 60-40 portfolio. I think it'd look really good, maybe as a replacement for some of the fixed income strategies. Why am I saying that? Because with low yields have gutted their cushion, rising rates like we saw in 22 really hammering their value, and shocks like 2020 where they sold off along with equities, not against them. Correlations crept up. Their safe haven status is questionable now. It's not ironclad as it was. I really believe that the defensive cluster, that orthogonal defensive cluster that we have within QIS, is engineered to really shine during those dislocations. And that's what I carried at UPS during COVID, and it worked out really well. I'd say that's really it. It really should be looked at as a complementary layer within the portfolio to add diversification into what you're running in your beta book.
You mentioned this idea a couple of times that being structural premia that you focus on instead of academic premia, you have to take a more dynamic approach in allocating among these strategies. I was hoping you could expand a little bit, double click on why you have that belief. I think obviously the congestion and crowding elements will play a factor there, but more importantly, how you approach being dynamic and applying that rotation while still maintaining that core degree of orthogonality among all the strategies.
Structural premium, like liquidity or vol, differ from academic because they're driven by real-time market dynamics. They're not static theories. And it's for that reason that we believe that they require that dynamic allocation, since there are potency shifts. Like you said, crowding can weaken them or stress can boost them, unlike academic premium that can really sit dormant for years. The approach we take, and I'll let Sid talk about the details, but it really starts with real-time analysis, dashboards that track signals like volatility spreads or flows to really gauge each premium strength. We then adjust allocations tactically, really favoring convexity during turbulent market times and carry during calm ones, really guided by market behavior and stress tests that simulate regime shifts. It's a mix of systematic rules and discretionary oversight, but really keeping the portfolio agile and aligned with these fluid premium to ensure that we do get those adaptable returns.
I'll give an example, I guess, to make things more clear. And this is one of the recent examples for us. If you look at vol premium or volatility risk premium, typically you would see that volatility risk premium can generate positive carry or positive yield. And this is driven by actual market flows because there are broker dealers who are writing these options to clients, and ultimately they have these exposures, and these options are priced above the risk exposure that they provide. So there is a structural premium there where if you had to actually replicate the payoff of an option versus buying an option, it would be cheaper for you. And so selling options should help you make money. But if you sort of dig through the volatility risk premium, there's layers to it. You could sell volatility by selling a variance swap. You could sell volatility by selling VIX futures. You could sell volatility by selling puts, by selling calls. You could sell vol by selling delta hedged puts and calls. All of these different formations, different structures are available to trade in the market. The question that you have to ask is, what is working? If you take the example of the past few months, what's really been happening is that we are in a lower vol environment, more from the equity lens, and now more so in the rates lens too, but let's focus on the equity lens. So in the equity market, if you see the vols have been constantly dropping to like 15, VIX has been dropping to 15, 14, 15, 14. A shock happens, is a very small shock, and it quickly rises and then reverts the next day. So what this causes is that, yes, there is a lot of reactivity or beta to vol, and again, realized vol as well, but ultimately, unless you're diversifying like every hour in the day, the vols that you are selling are quite low, which means that the spread, which is implied to realized spread, has been almost around zero or even negative at times. So the question then becomes, what should you do? On the other hand, if you look at the bigger picture for somebody who does not know about volatility, who does not know what is happening in the vol market, or if I'm delta hedging or not, they would basically see that S&P market is going up. So to correlate those two things, one of the things that you could do is you could shift from something which is not delta hedging or not a variance swap to just selling put spreads, maybe. Same question comes, why didn't you sell calls? Well, calls would have gotten hurt. That's why we are not selling calls. They could get hurt on the rebounds back up. All of these decisions, and I know these are a lot of different things to consider, all of these decisions are sort of packed or abstracted within the wall risk premium, within just equity wall risk premium that we are trying to create for a portfolio. So all of these thought processes, again, form part of the tactical edge that we are trying to offer while maintaining the core allocations and maintaining the core portfolio that we are trying to replicate over the years. This is the extra edge, as we would want to have it or call it.
I want to talk about the risk side here, because in your portfolios, you can have 30 plus different QIS strategies at any given time, trading a variety of different strategies and asset classes on different time frames, delta one, convex positions. How do you get your arms around the cross-sectional risks? And here I'm thinking especially about the conditional risks that may only emerge in certain different market environments.
If you think about the QI strategies, ultimately, these are transparent, liquid alternatives. There is a way to look through each and every of the QI swaps that you put on, that we put on at least here at Simplify. If you think about it, at the end of the day, let's say if you have 30 plus line items, you can actually look through those sub-components and create an aggregate list. And we have the operations team, the platform to be able to do that. At the end of the day, if you have those positions there, and these are all listed, traded, liquid market instruments, it's actually very easy to go in and look at the individual risks. When I say the individual risks, this is without accounting for the correlations and the cross gammas and the cross betas that we have across the different underlyings. At the first level, if somebody is just looking at, hey, how much delta do I hold? How much gamma do I hold in equities and in rates? This gives them a very fair estimate of how their portfolio looks like on a day-to-day basis. I'm guessing fairly simple to do if you have the platform and the infrastructure for it. So that's level one. Going from level one, some things which really pop in, as you mentioned, is the correlations or the cross betas that we see across different asset classes and underlyings that we have in our portfolio. Every institution would have their own way of tackling this. We have our own specific, more quantity way of looking at the correlation risk. There's two different layers to that. The first layer is within each asset class. So there's correlations across underlyings within each asset class. For us to be more conservative, we typically crank them up to 100, which basically means that we are trying to make sure that if you are selling S&P or selling Russell, I mean, if the 60% shock happened on the upside, I mean, both S&P and Russell would move by 60%. You would not want to underestimate your risk on S&P just because you know that Russell is more volatile than S&P. That's more within each asset class. And then across asset classes, we have some sort of regression come machine learning based model, which basically helps detect the changing betas that different asset classes have across different market environments. So it's a regime-based model which helps you understand how the correlations are changing, and ultimately those are used within the shock scenarios where we can see we have, let's say, long duration position and we have, let's say, long equities in normal market environments, we should get some benefit out of it. But let's say in an increasing rates environment where rates are increasing, so of course long duration should get hurt and equities are also going down, we should get more hurt, or this should add to the volatility of the portfolio during that time. That model helps us feed in those correlations into the top level risk model or top level shock model that we have and use that to create daily risk metrics, which are used in our portfolio. The one other layer that we have, we've sort of mentioned it before, is that we do have access to using certain OTC instruments so that we can cover some of those cross-asset risks. So for instance, rates versus equities is a very typical, very talked about risk these days, especially after rates have been rising over the past few years. We have something where we can take advantage of those correlations and hedge our book cheaper, or at least hedge those correlations in a way which is capital efficient and carry efficient. So we've also implemented that at the top level to be more cognizant of shocks and stressed correls, which ultimately don't show up in backtests and actually may not have even occurred in the recent history, the unknowns, as you call it, and account for them in the portfolio going forward.
We take into account correlation and all the conditional risks really in the development of the orthogonal risk vectors. So I say we took a multi-dimensional approach. Some of the inputs into that are not only correlation, which is what you get from a normal covariance matrix, but conditional expectations given a move in the underlyings that we have. That may be one of them. Co-skewness, the movement of these strategies, how they work with each other from a skewness perspective. Time correlation. What is the time correlation across these strategies? So there's a number of quantitative metrics that create these clusters through a kind of advanced ML hierarchical agglomerative clustering method that we use. But the edge that we have is the way that we create the distance to create those clusters. And that's all factored in to create those orthogonal vectors to really manage that risk and understand that there's hidden risks, shadow risks, other than correlation that we need to take into account as well. And then once we create them, the stress testing is important. So you got to test it during COVID, test it during 08, test it during normal times. See that you're getting the results that you're looking for, which is that uncorrelated return profile that keeps its diversification in normal times, but more importantly, keeps or improves its diversification during stress periods. And that gets tested thoroughly, both in and out of sample, to create the portfolio.
You mentioned earlier that you often customize the QIS offerings before you allocate to them. Can you peel that back for me? What are you looking to customize? How do you customize them?
Customization is vital for us to ensure that our QS offerings are delivering their edge. Banks definitely provide robust indices, but we think that they often need refinement. Sid mentioned earlier, we really want to isolate the pure factor. Many strategies mix elements for backtest appeal, really diluting clarity. So we really strip those away to target the core structural premium that we're after. With that economic rationale, it gets sharpened. That's really ensuring us it's tied to a durable dynamic and not flukes. That's very important. Execution is also optimized for adjusting the parameters that we get from the banks, like timing or asset selection, to really cut the costs like slippage and fees. Sometimes the risk profile is tweaked. We want to balance volatility or liquidity to really fit the framework that we need to put it in without losing its intent. It's about distilling the premium, streamlining execution, and really aligning risk that makes the strategy precise and effective in live markets. And that's typically what we're looking for when we do tweak a bank strategy.
That's a great summary. If you just had to count them on your fingers, I guess it's the risk profile, it's the trading profile to make something more or less reactive. It's implementing some of our key insights because we want to embed our own IP in some of these strategies, what we have learned over the years. And the last thing is always making things more simple and removing some sort of hybrid premia that typically banks tend to offer. Something which is more pure, simple, single premia so that we know what the profit or loss is coming from. That's the four things that we typically aim for when we do customizations.
How beholden are you ultimately to bank IP? Or operationally, how beholden are you to the bank being willing to trade with you at all?
We're not overly tied to bank IP or their trading willingness. We definitely view banks as partners, and we like to leverage their expertise in structuring, execution to enhance our QS offerings, create those systematic strategies to target that specific premium we're after. But their indices are a strong base, and their execution capabilities are really key. But we're not dependent. What we're really thinking about is refining their IP in-house and really construct QIS strategies ourselves to meet specific needs. If a bank hesitates to trade, we may pivot to others or build internally. Using multiple partners is key as well to maintain liquidity and flexibility we need. But at the end of the day, we look at it as a collaboration where we harness their strengths while still trying to keep a modicum of control over what we're offering.
As we mentioned before, we do have the full-fledged service available where we have traders, we have ops, we have the full team available if he did want to trade something. We do have QPAM capabilities as well. So ultimately, if something was there and we knew there's a premium that we would want to trade, we can, of course, try and trade it in-house as well. We do recognize the operational efficiencies that the banks have to offer, and they are long-time partners, and they often are very willing to create custom strategies with us. In that sense, it's always easy to find someone to partner with.
It's really like a collaborative dynamic, not a limitation. We definitely tap into their structuring and execution skills, but also use our in-house capabilities so we can deliver that tailored, robust strategy, regardless of what their stance is. We're not using bank blueprint, for example. We're trying to target certain risk premium that are out there. One bank just doesn't have that premium. The whole host of bank can source that for us. That's how we look at it.
As you start to explore this space, you often find that different banks have different reputations for strategies in different asset classes or structures. Curious how you choose which banks you trade which products with.
Given that I've already worked at many of those banks before and create those strategies on the side of the table, I think every bank has their own strengths and weaknesses, whether it's infrastructure, whether it's what they're trading, the strength of their trading desk, the strength of their ops technology. There's a lot of things that go into what they ultimately offer. I've often seen stuff which originally were bugs offered as, hey, this is a new feature that we can offer in our strategy. So all of that is there and it's part of the book. When you look through the costs, the strategies, and even the breadth of strategies actually across the banks, you can soon realize that there are certain specific product types and strategy types that the banks are really good at. You can find a lot of banks that can give you general premium of long short, let's say equity factor. But let's say if you're trying to figure out, hey, how do I solve this very specific hedging problem or very specific intraday problem, there's going to be a very small subset of banks that can help you create those solutions. Given that we've been in this industry for a very long time, Roxton as a user, me as a creator, we've seen different sides of the business. We have those relationships to lever. It becomes very easy to see where we can go and gather the best of products, which basically is what we are, of course, trying to do in our QIS ETF and the SMA.
Given the number of counterparties that you could have at any given time, walk me through how you think about the collateralization optimization problem that you face.
Thankfully, I've been on the other side, so I have some understanding of how the risk team looks at it. If you think about it, essentially what they're looking at is how much risk do these underlying strategies hold. So that insight has been very, very helpful. The simple answer is we typically go for a risk-based pairing, which basically helps with the margins. A way to think about that is typically in a carry portfolio, you have risk-seeking strategies. We try to pair them up with risk mitigating strategies to trade them as part of an overall portfolio with the bank to help lower those margin costs. It's not just margin costs, actually, and I know you've specifically asked for those margin optimization, but it also helps with costs. And why I say that is because let's say if you were selling calls, if you were also selling skew, one of the things that you would notice is that you're buying and selling calls in both of those strategies. So you can have some sort of benefit where you're buying and selling the same thing and hopefully don't have to pay in and out costs on both sides of the trade. So those types of decisions are something that we are very cognizant of. How it looks practically in the portfolio is that essentially, let's say if there's two strategies, which we like, strategy A and strategy B, in an ideal world, if we had no other strategy in the portfolio, we would go with strategy A. But given that we do have a portfolio already, what we would do is we would go with, let's say, strategy B, which offers a little less in risk-adjusted returns or in general returns. But because of the fact that I'm pairing B with, let's say, Z that I already have in the portfolio, now B and Z can give me a 50% margin benefit, which basically means that my return on capital invested has increased by a lot. So those type of decisions, even though they seem small for a new user, you might want to go to the best out there. This can actually help create a lot of benefits in the portfolio, which ultimately pay off.
For larger institutions that might already have access to all these strategies themselves, how would you answer the question, hey, I can do this directly myself. Why should I work with your team?
I think the answer hinges on efficiency, expertise, and execution. Sure, you can go negotiate with banks, replicate strategies, and manage them solo, but that is a very heavy lift because that's what you have to do this right. I think a lot of people rely on the back test that banks give them. They run some historical analysis. They look uncorrelated. They look like they deliver two sharps. They say, let's put it in a portfolio. This is going to be easy. And they end up with a really expensive T-bill. It just doesn't work. You got to roll up your sleeves and you got to do the work. We'll save you time and effort by curating a portfolio of QIS strategies that really hones them to isolate pure factors and strip out the complexity that really muddies the back test. Beyond the curation, even, we streamline access. Direct engagement with the banks often means tackling operational hurdles like documentation, counterparties, execution logistics. But we handle that. We're delivering an institutional grade strategy with daily liquidity, transparency, and we're taking off the administrative grind associated with running these. And then there's the dynamic allocation. A real-time adjustments across premium is something that is value add. And you got to be in front of it all the time and really have a deep down understanding of what they're doing, what the market conditions are, and how these strategies are going to react to those market conditions. Unless you really are intimate with these, a lot of people don't know how they're going to return or what the risk is given different macro environments. We're offering that by giving that dynamic nature to them. Plus, at the end of the day, we optimize costs. We leverage scale to trim down some of the fees that they may have or that they may be charged from the banks directly. You could do it yourself, but we're offering a turnkey solution. It's a refined, adaptable portfolio that will let you focus on your core priorities while we manage the QIS engine efficiently and precisely and at a lower operational burden. At the end of the day, we're QIS nerds. This is what we love to do. We're QIS hackers for you, and we want to deliver to you the best outcome that QIS can bring.
To sum it up, it's the tactical aspect, the cost efficiencies, the risk framework, and also the information aspect, because you can't expect everybody to have this much access to all the information, all the touch points, which hopefully we do, and we can offer that as a service.
You offer your services both as an SMA solution for institutions, but you also run a QIS portfolio within an ETF. How would you compare and contrast these both in their objectives as well as the unique constraints that the structure provides?
At a high level, both the SMA and ETF aim to deliver that uncorrelated absolute return profile through QIS, really leveraging the structural premia given within that defensive carry-driven strategy framework that we developed. The SMA offers customization, so you can really tailor the risk or the premium focus to the institution's needs, while the ETF really provides more of a broad, accessible solution, really emphasizing simplicity for diverse investors. Constraints differ as well. SMAs have a lot more flexibility. There's no public disclosure, allowing more niche type strategies, but do require high touch management. The ETF really demands that transparency and daily liquidity. So it's limited holdings to very liquid assets with lower costs and no tax complexities like K1s. Within the SMA framework, we prioritize precision, I guess you could say, and the ETF really focuses on simplicity. Both deliver the QIS value, just in different lenses.
For us, SMA is like a scalpel where you can go in and help solve the exact problem that you had, while ETF is more of a sharp knife where you're trying to do the best you can with what you have. It's both worlds combined. I mean, it's easier to access, of course. Well, SMA might be a little bit more difficult, but both of these are available and those solutions are out there, with SMA being more customized.
All right, gentlemen, it's come to the last question of the podcast, and this is the same question I've been asking guests all season. So this is a good test of whether you've been listening. The question is, what are you currently obsessed with? And it can be something you recently learned. It could be a book or a show, a topic, a podcast. It could be anything you're consuming or doing or a hobby, something you're learning. What currently has you obsessed outside of work?
So more recently, I lost a loved one and it was a difficult path. So I've been reading more about reincarnations, births, and what it means to go beyond this life. It's exciting and can get very scary, but I enjoy the aspect of thinking about something bigger than what I'm dealing with on an everyday basis, so that S&P market going down by 5% doesn't trouble me too much.
I had the opportunity to invest in a quantum computing company as a startup a couple of years ago. Really interested in how to harness the power of quantum cognition machine learning and really applying that to the QIS framework for even better, robust estimation of what the intrinsic dimensional data sets are across those QIS portfolios. So we do it in a machine learning way, but imagine if you could tag quantum and say, this QIS has these quantum profiles, and then use quantum machine learning to figure out where the actual manifold exists and where the actual risk vector sits, I think could be fascinating. The firm that I invested in just did a few white papers on that. I think BlackRock is actually using it currently, their model. So I don't want to get behind the curve on there. I always want to be on the cutting edge. I have a long ways to go with that because it is a black box, but it's been kind of an obsession with me. So I've been learning as much as I can about quantum computing, interdimensions, and looking at different ways to maybe even make our portfolio better in the future.
Sounds like a great topic for another podcast. Let me know in a couple of years, Roxton, when you're free again, and we'll do another one.
It may take more than that, Corey. We'll do it another 4.
That sounds good. Gentlemen, thank you so much for joining me. It's been a pleasure.
Thank you, Corey.
Thank you.